$10 a month turned two guys in Atlanta into $5 billion men, and they did it without a single investor in the room. There was no VC stack, no liquidation preferences, and no board seat traded away. No late-stage investor holding a ratchet that quietly eats the upside before the founders ever see a dollar. Every cent of a $12 billion sale flowed to two people who had spent 20 years saying no to every firm that called. Go back to the year 2000. The dot-com bust has just wiped out half the internet companies in America, and Ben Chestnut has just been laid off from Cox Interactive Media. The survivors of that crash all had one thing in common: real revenue, real customers, and no bloated payroll propped up by investor money that had suddenly evaporated. Chestnut watched companies with massive funding rounds die overnight, and he took the lesson personally. That single observation, made while he was unemployed and nearly broke, is the reason he would later turn down hundreds of millions of dollars without blinking. He and Mark Armstrong start a web design agency called Rocket Science Group. Dan Kurzius joins them. Three guys, no outside money, building websites for small businesses that couldn't afford a big agency. In 2001, a client asks if they can build a tool to email customers. The team hacks one together, slaps a cartoon chimp on it, prices it at $15 a month, and calls it Mailchimp. Nobody in Silicon Valley notices. For 6 years, it stays a side project. The agency pays the bills while the email tool quietly compounds in the background, a curiosity that throws off a little recurring revenue every month, but nothing that feels life-changing. Then in 2007, Chestnut and Kurzius do the thing most founders never have the nerve to do. They shut the agency down completely and bet everything on the side project, with no safety net and no second income. The revenue is growing, but it is nowhere near enough to feel safe. They do it anyway. The freemium pivot in 2009 is when everything changes. Before it, Mailchimp is a paid-only tool with 85,000 users. Within 12 months of giving the product away, that number jumps to 450,000. And revenue grows 650% in a single year. They didn't raise money to fund that growth. They let small businesses use it free, watch them grow, and charge them once they were big enough to need the paid features. That is the mechanism most people miss. Giving the product away for free is normally how a startup burns through a venture round, because free users cost money to serve and don't pay it back. Mailchimp ran it the opposite way. The free tier was the marketing budget. Every small business that signed up for nothing was a future-paying customer the company never had to spend $1 to acquire, and the ones who grew turned into revenue automatically. A venture-backed competitor was paying for ads and a sales team to chase the exact same customers Mailchimp was getting for free. The revenue compounds from there, roughly $30 million a year by 2012, around $700 million by 2019. And by the time the Intuit deal closes, the company is clearing about $800 million a year, with 13 million users. All of it funded internally, without a single dollar of outside capital. During that entire stretch, the phone never stops ringing. Mailchimp's competitors are going public one after another. Constant Contact gets acquired. SendGrid raises venture rounds and IPOs in 2017. HubSpot raises over $100 million before going public in 2014. Venture money is flooding into email marketing, and every partner at every firm in Atlanta, New York, and San Francisco has Chestnut's number. He takes the meetings, he listens to every pitch, and then he says no. The pitch is always the same shape. Raise a Series A, then use that money to move up market and chase enterprise clients while building out a real sales team to accelerate toward an IPO. It is the standard venture playbook, aimed at a company that was already working exactly as designed. What Chestnut understood, and what he repeated across years of interviews, is that every one of those firms wanted Mailchimp to stop doing the thing that made it work. They wanted him to gut the free tier that was acquiring customers at almost no cost, and walk away from the small businesses that had built the product to spend years chasing enterprise deals that took a year to close. The investors weren't wrong about what that strategy could produce. A venture-backed, enterprise-focused Mailchimp might genuinely have reached a bigger headline valuation, but it would have been a different company owned by a different structure, with a completely different payout waiting at the end. Chestnut understood that trade better than the people pitching him, and he kept saying no. By around 2015, the calls aren't just funding offers anymore. The acquisition interest starts arriving, and one number being floated is $200 million. For most founders, that is generational, life-changing, take it and never work again money. Chestnut turns it down. He waits 6 more years, and that patience multiplies the eventual payout roughly 25 times over. Here is what nobody covering this story actually models out. When a venture-backed startup sells for $12 billion, the founders do not split $12 billion. The capital stack takes its cut first, and that cut is enormous. A SaaS company that runs the standard funding path, seed, then Series A through D, typically sees the founding team diluted down to somewhere between 15 and 20% of the company by the time it exits. That isn't a worst case. According to Carta's analysis of thousands of real cap tables, it's the median outcome. Run the numbers. At 15% retained, a $12 billion exit pays the entire founding team about $1.8 billion. At 20%, around $2.4 billion. Split among several founders, that is real money, but it is a fraction of the whole. Chestnut and Kurzius retained 100% between 2 people. The gap works out to roughly $4 billion per founder, not because a VC-backed Mailchimp would have sold for less. Assume the exit price is identical. The gap exists purely because of who owned the equity the moment the money landed. And the equity wasn't the only thing they kept. A venture-backed founder usually can't even decide to sell on their own. There's a board to satisfy, investor consent rights to clear, sometimes a supermajority vote, and liquidation terms that dictate who gets paid first. Chestnut and Kurzius had none of that. No board, no co-investors, no outside vote of any kind. 2 people with a spreadsheet and a monkey logo could decide to sell $12 billion of company between themselves over a conversation and answer to no one. That control is the quiet half of the story the coverage skips. Chestnut didn't out-hustle the venture-backed competition. He out-structured them. In the fall of 2021, Intuit announces the deal that ends 2 decades of independence. The structure is about $5.7 billion in cash, funded largely by new debt Intuit takes on, plus around $6.3 billion in Intuit stock. Total, roughly $12 billion, at over 12 times Mailchimp's revenue. One of the richest multiples ever paid for a bootstrapped company. Chestnut and Kurzius had bought out their 3rd co-founder back in 2008. After that, the 2 of them owned Mailchimp 50-50, with no outside equity of any kind. No preference stack, no vesting cliffs on their own shares, just 2 people who had quietly agreed over 20 years to own all of it together. The deal closes. Each founder receives approximately $5 billion. 9 months later, Ben Chestnut is gone. In August 2022, Mailchimp's newsroom publishes a short announcement that Chestnut is stepping down as CEO. An Intuit executive from the QuickBooks side takes his place. He had already told everyone this was coming. In a 2022 podcast, he said, and this is a direct quote, "I knew I'd quickly become irrelevant." He was right in 9 months. Chestnut wasn't bad at corporate politics. The problem was structural, and structural problems are harder to fix. What made Mailchimp worth $12 billion was an obsessive, non-negotiable focus on small businesses and the free tier that fed them in. An enterprise software company like Intuit had no framework for protecting that. After Chestnut leaves, Intuit makes every move he spent 20 years refusing to make. Prices go up, the free tier shrinks, and the roadmap bends toward QuickBooks instead of small business email. Customers start migrating out. By mid-2025, Mailchimp has stalled near 11 million users flat, while every major competitor climbs. Industry reporting says Intuit explored selling the platform, couldn't find a buyer near the $12 billion entry price, and now runs it mainly for cash flow. That is the exact fate Chestnut spent 2 decades engineering his exit to avoid. The company he built by serving small businesses is now being milked by the corporation that couldn't understand why it worked. The popular version of this story is that Chestnut and Kurzius were just stubborn and got lucky on timing. The math says something else. Staying bootstrapped didn't just preserve their freedom, it directly set how much money each of them walked away with. Every no to every investor and every term sheet and every early acquisition offer wasn't a personality quirk. It was a 20-year capital allocation strategy that produced roughly $4 billion in extra wealth per founder at the exact same exit price a venture-backed team would have hit. The structure came first. The payout was just the structure, paid out. 2 guys in Atlanta said no to 20 years of investor calls, not because they feared the money and not because they misunderstood how venture capital works, because they ran the math early, saw exactly what saying yes would cost them at the back end. and decided the equity was worth more than the acceleration. The largest bootstrapped exit in American history didn't happen in spite of refusing outside capital. It happened because of it. Roughly $8 billion at the very same exit price separates what these two founders took home from what a standard venture-backed team would have netted. That is about $4 billion each, and it was created entirely by choices that looked, from the outside, like nothing more than stubbornness. If you made it this far, thank you. Please like and subscribe and check out our other videos dropped weekly. Ben Chestnut walked out of the company he'd spent 21 years building. He left just 9 months after handing its keys to a corporation that paid $12 billion for something it couldn't run. He had said out loud that he knew he'd be irrelevant the moment he sold, and he proved himself right in under a year. He also walked away with enough money to prove a harder point. Being irrelevant at exactly the right moment on your own terms is worth more than staying relevant forever on someone else's.